Opera Limited just reported their Q2 2026 earnings, and they delivered a mixed quarter with a top-line revenue beat, but a slight miss on adjusted EPS.
Right, revenue came in at $178.1 million, which is up 25% year over year.
Yeah, but that EPS missed slightly, coming in at 26 cents versus the expected 27.
Still, management immediately raised full-year guidance.
Exactly. They're now projecting $734 to $742 million in revenue and $172 to $175 million in adjusted EBITDA.
And you have to mention that stock reaction. I mean, it was a total roller coaster.
Oh, for sure. Shares initially tanked over 7%, down to $18.12 on day zero, mostly due to that EPS miss and, some profit taking.
But value buyers stepped right in, driving a full recovery to nearly $19 by day two.
Right. So the market clearly digested that slight EPS miss and realized the underlying engine is actually roaring. Our mission in this deep dive is to figure out how a 30-year-old browser is quietly transforming into an AI and fintech powerhouse right under Google's nose.
To understand that rapid two-day stock recovery, you really have to look past the headline miss and see the broad-based growth driving their fundamentals.
Yeah, like advertising jumped 27% to $115.4 million.
Right, and query revenue reached $62.1 million, which is up 21%. Plus, they aren't just, burning cash to buy that growth.
No, definitely not.
OPRA achieved an adjusted EBITDA of $42.4 million, which is a highly efficient 24% margin. And this is crazy. That marks their 21st consecutive quarter hitting the rule of 40.
Wait, 21 quarters? So they've consistently maintained a combined revenue growth and profit margin of 40% or more?
Exactly. That sustained balance is incredibly rare in tech right now.
Yeah, I think of their query and ad segments like a hybrid engine. The search queries are the open house that brings people in and tells Opera exactly what the buyer wants.
Right, and then the ad placements are the targeted sales pitch locking them in.
Exactly. But looking at user metrics, you kind of have to wonder. They report 288 million total monthly active users, but only 61 million of those are in Western markets.
Yeah, it's a much smaller slice.
Right, so is that smaller, highly monetizable Western base really enough to fight off behemoths like Chrome and Safari?
Well, they aren't trying to beat Google purely on global volume. The strategy relies entirely on targeting high-intent users, right? They optimize the browser interface to maximize average revenue per user, or ARPU, within that specific 61 million cohort.
Got it. So to extract more cash from that small Western user base, you have to keep them on the browser longer.
Exactly, which is why CEO Song Lin is pouring resources into AI.
Like their new browser connector and those agentic browsing tools they just rolled out.
Yeah, I mean, AI that actually performs complex tasks for you, rather than just answering basic search questions. Management noted these integrations are significantly boosting user engagement.
Which makes sense if you're spending an extra hour a day in the browser because AI is natively managing your tabs or, summarizing pages.
It directly increases the digital real estate available for advertising and search queries. It changes the browser from a passive window into an active assistant.
Right, which is a massive driver for those ad revenues. And the operating leverage here, how they scale revenue without adding proportional costs, really shines with their fintech integration.
Oh yeah, their mini pay wallet. It's scaled to 18 million users.
Wow, 18 million.
Yeah, up 121% year over year. And because it lives natively in the browser, customer acquisition costs are just incredibly low.
So that's why management expects a 25 to 40 basis point expansion in adjusted EBITDA margins over 2025.
Exactly, purely because of this structural advantage. But, you still have to weigh that optimism against some very real macro risks.
Right, like digital ad budgets being incredibly sensitive to the broader economy.
Yep. If consumer spending cools, that highly monetizable ad spend drops quickly. Plus, intense legacy browser competition is always waiting to poach users.
Not to mention, continuous AI adaptation requires massive R&D spending. That could severely pressure those margins they just promised to expand.
The R&D is a heavy financial lift, certainly. But evolving data privacy regulations globally could actually hurt their legacy competitors more.
Oh, really? How so?
Well, strict privacy rules might restrict some of the tracking that makes Opera's hybrid ad engines so profitable, sure. But a closed ecosystem where users willingly utilize built-in AI and fintech tools gives Opera a unique first-party data advantage.
I see. So it all comes down to balancing that operating leverage against the rising cost of staying relevant. But consider this final provocative thought from their balance sheet.
Yeah, they are sitting on $145 million in cash and minimal debt.
And a 9.5% stake in OPRA that is valued at over $300 million alone.
Which really makes you wonder if the market is mispricing Opera, like treating it just as a browser company when it's increasingly looking like a stealth AI and fintech holding company.
Yeah, that's a very expensive question to get wrong. Make sure you follow the deep dive for daily earnings coverage so you never miss these breakdowns.